How's it going, everybody? Today we're going to be going over how to use ICT concepts to identify a daily bias. These are the three ways to identify a daily bias. We have a break of structure, an imbalance, aka a fair value gap, and liquidity. And I'm going to go into each one of these individually and explain to you and show you a live example of how these apply to the market and how we could form a bias based off of these 3 points. Now, just remember, your daily bias is a break of structure plus an imbalance and plus a liquidity. And using this formula, you will have the direction right 90% of the time. Now, there's a lot of fancy words that people and traders love to use online, but I'm going to keep this as simple as humanly possible for you. Now, these are all concepts that I use inside of my mentorship, so if you're interested in that, I'll leave a link to that down in the description. First off is a break of structure. Just in case you don't know what a break of structure is, let's say the market is in an uptrend. We make a higher high and a higher low, and a higher high and a higher low, and a higher high, and so on and so forth, right? Every time price breaks above this previous higher high and creates a new one, this is called breaks of structure. Now we're going to use this to be able to identify where the strength is in the market and which direction we're trending in. Secondly is an imbalance or a fair value gap. An imbalance is a 3-candle pattern. Candle 1, candle 2, candle 3. What's happening in this example is price is being pushed down at a harder rate than buyers can keep up with. Therefore, price is buying to the upside. Sellers come in heavy. This 5-minute candle closes, and now this new candle is created. But as you could see, these candle wicks do not have overlapping. This is the imbalance in the market, and I'm sure most of you understand what an imbalance is or a fair value gap. So I won't spend very much time with it, but it's crucial to know that in these imbalance areas, this is where heavy buyers and sellers are set in at. Finally, liquidity. These are areas in the market where buy orders and sell orders are sitting waiting to get filled, and stop loss orders are in these areas as well. Big institutions love to push price into these areas to be able to take out the traders in them to then move into their desired direction. This is effectively how the market moves. You could see that price is constantly finding liquidity, taking out traders to then move in desired direction. So looking at this quick little example, this is pretty perfect market structure, but we could see that, right? We have sell side liquidity get taken out. Price then pushes to the upside, breaking structure. An MSS is essentially a market structure shift. That's just a fancy way of saying break of structure. Price creates a new high while also leaving behind a fair value gap or an imbalance. Remember our 3-candle pattern, we have that area where big buyers are sitting. Now, it says bullish bias here. Well, no shit. But we could see that price tagged into this area after sweeping liquidity and breaking structure. What was the reaction out of that area? Well, it was a big impulsive move to the upside. So now we understand how to use these 3 confluences to be able to identify a bias and take a trade. I'm going to show you a live example we took in the live call last week. Now, if this chart looks difficult to obtain a daily bias on, let me tell you why it's not. We have a clear break of structure, imbalance, and pool of liquidity that we want to see swept out before we can take a trade. Now, if it's not clear to you where our break of structure, imbalance, and liquidity is, I'm about to show you that right now. We're going to go step by step. First of all, we're going to be using a break of structure. Have you ever heard the term the trend is your friend? Well, a lot of ICT traders like to shit on that term, but personally, I love to use it. As we could see, price is inputting higher highs, higher lows, higher highs, higher lows, higher highs, consistently breaking structure to the upside, especially with this move right here. This ideology is especially clear on the 1-hour chart. We can see that we put in a higher high and higher lows up in this area. What happened? Price broke to the upside, closing above previous highs, therefore creating a new higher high, higher low, higher high, and then soon to make a higher low. But let me show you the next step. Thinking back on our example before, as we're breaking structure to the upside, we're leaving behind fair value gaps or imbalances as they actually are. So you can see this is the 15-minute chart. Price broke to the upside, closing above it, creating a new higher high. But remember what an imbalance is. It's a 3-candle pattern. What happens here? This middle 15-minute candle doesn't have any price overlapping in this area. This, my friends, is an imbalance. This is an area where price up in here is going to want to retrace into to then push back to the upside to take liquidity. Now, we're going to have to actually find a point of liquidity inside of this gap. Now, I like to find these gaps or these quote unquote imbalances on the 15-minute, the 30-minute, the 1 hour, and the 4 hour. So remember, we're breaking structure to the upside while leaving behind imbalances. These two confluence already are telling me that we want to continue to be bullish essentially. The only way I could be bearish in this area is if we start closing below these higher lows. Close below that one, close below that one, close below this one. Until that, we have to assume that this trend is going to continue to be true, and we're going to retrace into this area, sweep out some generated liquidity to go to the upside. But let me fast forward a little bit. Now that we have steps 1 and 2, we have our basic direction and we have an imbalance. Third, we need to understand where liquidity is. So this was actually CPI last Friday, and me and my team, we took a trade inside of the live call, and we took out this little point of liquidity sitting above, aka the data wick. But how did we do this? Well, we understand that in order for the market to move, liquidity must be taken in one direction to then reverse into our desired direction. So what do we see here? Remember, we have our break of structure looking left. Remember, we have our higher high sitting left that we broke. We closed above it, as we can see. Now we have our 15-minute gap as shown here. Well, this is the 5-minute, but we have our gap on the 15-minute. Now what do we have here? We have liquidity buildup sitting right above our higher time frame gap. So quite literally, all we're going to wait for is price to then retrace into this area to then be able to take a buy to the upside. And as you can see here, price is now taking out all of this liquidity pool sitting in this area. So now you may be wondering, how can we capitalize on this? Well, me personally, my favorite entry trigger is the 13 EMA. I use this in all of my trades because this helps me understand when I have my bias correct and I get an aggressive breakout of the 13 EMA. Institutions are ready to move price after seeing all of these confluences. Break a structure, remember looking left, breaking all these previous higher highs. So we have our break of structure, we have our higher time frame gap, and then we have liquidity sitting in this area. So what I do is I put on my 13 moving average exponential. That's this little line on my chart. This is going to act as my entry confirmation. And quite literally, all we're going to do is wait for a breakout of this 13 EMA. So I'm going to play price until we break aggressively. Price now aggressively breaks the 13 EMA. What are we going to do? Well, we're going to put our entry trigger, our entry tool at the top of that 5-minute candle. This is the close of the 5-minute candle right here. After all these confluences, yet again, we have our entry confirmation breakout of the 13 EMA. So your entry is at the close of the 5-minute candle, and your stop losses are always going to go below the entry candle. This is extremely crucial because when we have all three of these confluences that we've been talking about, when price distributes the 13 EMA like this, institutions are ready to rip. Liquidity's been taken. These fair value gaps or these imbalances, remember, they've been filled. This big candle left behind an imbalance. What is an imbalance? It's an area where the market needs to rebalance and fill orders because there was a surplus of buyers in that area. When we have this distribution or this displacement, whatever you want to call it, that's when institutions are ready to rip. Now, we understand that price goes from point of liquidity to point of liquidity, and this is an 830 high. Actually, this is an 825 high. This is the 830 high, so we could still use this technically. This was a little bit of an odd CPI, though. I will not lie. But you could see price played out pretty darn good. Eventually, we get up there. And that's how you identify your daily bias. Always remember this formula, and you will have the direction right so often that it's going to feel so much easier to trade. And I really hope you guys got a lot of great value out of this video. I know that using this formula into my trading has absolutely skyrocketed it, and it will for you too.